Tom and Rachel bought nearly identical homes in 2010. Three-bedroom houses in the same suburban neighborhood, same square footage, same purchase price of $380,000. They each put 20% down, borrowed $304,000 at 4.5% interest on a 30-year fixed mortgage, and their monthly principal and interest payment came to approximately $1,540. By 2015, both of them had found an extra $400 per month in their budgets, a raise, a paid-off car, expenses that had finally cleared. They had the same conversation about what to do with it. Tom chose to accelerate his mortgage. Rachel chose to invest instead. Here's the thing. This is the second most common money debate after debt versus investing, and most people resolve it emotionally rather than mathematically. The mortgage produces a powerful psychological pull. The balance drops visibly. The payoff date is calculable, and the home becomes fully owned years before the neighbor's mortgages expire. The math, when run completely at 4.5% interest, produces a result that challenges that pull directly. This video is that result. Let's start with what extra payments actually do to a mortgage. Tom's remaining balance in 2015, 5 years into the loan, was approximately $281,000. His standard payment of $1,540 applied over the remaining 25 years would generate approximately $181,000 in additional interest, for a lifetime interest cost of roughly $249,000. Tom added $400 to his monthly payment. He was sending $1,940 per month to his lender. The extra $400 applied directly to principal, reducing his balance faster, reducing the base on which interest accrued, and compressing his remaining term from 25 years to approximately 16 years and 4 months. But here's what. The mechanics of amortization make early extra payments significantly more powerful than later ones. In month 61 of Tom's loan, where his story starts, approximately $810 of his standard, $1,540 payment went to interest, and $730 went to principal. His extra $400 went entirely to principal, reducing his balance by $1,130 that month instead of $730. Each dollar eliminated in month 61 saved 4.5% in annual interest on every remaining year of the loan. This is the guaranteed return on extra mortgage payments. Exactly the loan's interest rate, 4.5% per year, it's on every extra dollar applied. Certain, computable, and entirely independent of market conditions. Tom paid off his mortgage in late 2031. 21 years after buying the house, he owned it outright. Total interest paid over the life of the loan, approximately $161,000, saving roughly $88,000 compared to the standard schedule. His home, appreciating at approximately 3% per year for 21 years, was worth roughly $686,000. He held $686,000 in home equity, zero outstanding debt, and no investment portfolio built during the payoff period. His former $1,940 monthly payment was immediately redirected to investing. Tom's position at his payoff date in 2031: $686,000 in home equity, $0 in investments. Now let's look at Rachel. Rachel paid her standard $1,540 per month and did not add a dollar beyond the minimum. Beginning in 2015, she invested $400 per month into a total market index fund inside her Roth IRA, setting up automatic monthly contributions and dividend reinvestment. From 2015 through late 2031, the same 16 years and 4 months Tom spent paying extra, Rachel's $400 per month compounded in the market. At a 10% annualized return, $400 per month invested over approximately 196 months grew to approximately $193,000 by the time Tom made his final mortgage payment. Here's the thing. At the exact moment Tom celebrated paying off his mortgage, Rachel had 2 things he did not: a $193,000 investment portfolio and 9 years remaining on her own loan. Her total net worth, $193,000 in investments plus approximately $248,000 in home equity from 21 years of standard payments, was approximately $441,000. Tom's total net worth at the same moment, $686,000 in home equity, zero investments. Tom leads by $245,000 in total net worth at his payoff date. On a spreadsheet, he is winning. And here's the part that changes when the window extends to the full 30-year horizon. The payoff date comparison favors Tom because Rachel still carries a mortgage balance and has not yet deployed the full compounding advantage of her early investing. Extend the window 9 more years to 2040 when both mortgages are fully paid under the original 30-year schedule, and the picture shifts. After 2031, Tom invested his full $1,940 former mortgage payment each month at 10% annualized $1,940 per month for 9 years, 108 months, compounded to approximately $357,000. Tom's position at year 30, $357,000 in investments, home fully paid, home equity equal to Rachel's. Rachel's $193,000 portfolio in 2031, growing at 10% for 9 additional years, reached approximately $456,000. She also continued investing $400 per month during those 9 years, an additional contribution block growing to approximately $77,000. Rachel's total investment portfolio at year 30, approximately $533,000. But here's what. Rachel paid approximately $88,000 more in total mortgage interest than Tom, the savings Tom generated through his extra payments. Subtracting that cost, Rachel's investment portfolio of $533,000 versus Tom's $357,000 produces a $176,000 gap. After adjusting for the $88,000 extra interest Rachel paid, her net position advantage is approximately $88,000. The earlier compounding Rachel accessed, 196 months of $400 per month before Tom started investing, produced a compounding advantage that the full cost of her additional interest charges does not erase over 30 years. Now let's talk about the rate variable, because the rate is where the math changes direction entirely. Tom's mortgage was at 4.5%. Rachel's expected return was 10%. The spread was 5.5 percentage points annually, compounding in Rachel's favor for 30 years. That spread produced the $88,000 net advantage Rachel held at year 30. Here's the thing. Raise Tom's rate and the spread narrows. At a 7% mortgage rate, which became common in 2023 and 2024, the spread between the guaranteed 7% return on payoff and the expected 10% investment return narrows to 3 percentage points. The math still technically favors investing, but the margin shrinks. The certainty premium on payoff becomes more attractive, and the risk-adjusted case for extra payments strengthens. At 8% or above, the guaranteed return on mortgage payoff becomes directly competitive with the expected equity return. A guaranteed 8% return, what each extra dollar earns in saved interest on an 8% mortgage, is a compelling alternative to an uncertain 10% market expectation over any specific holding period. The 2 percentage point spread does not compound the way the 5.5 point spread does. And here's the part that reframes the 2020 to 2022 refinancing window. Millions of homeowners refinanced to rates between 2.5% and 3.5% during that period. Those homeowners hold mortgages with guaranteed payoff returns of 2.5% to 3.5%, against a historical expected equity return of 10%. The spread in favor of investing is 6.5 to 7.5 percentage points annually. The mathematical case for paying extra on those mortgages is at its weakest in modern history, and yet many of those homeowners continue accelerating payoff schedules while holding investment accounts earning 4% to 5% in money market funds alone. Now let's talk about liquidity, the variable mortgage payoff advocates most often underweight. Tom's strategy converted $400 per month into home equity, an asset that cannot be accessed without selling the home or borrowing against it. By 2031, he held $686,000 in a single illiquid asset and zero accessible liquid savings accumulated during the payoff period. Rachel's $193,000 in 2031 was inside a Roth IRA, Contributions to a Roth IRA, the principal deposited, not the growth, can be withdrawn at any time without penalty or tax. Her contributions of approximately $78,400 over 16 years were accessible for genuine emergencies at any point without triggering a tax event on the contributed amount. But here's what. For 16 years, Tom had no liquid savings buffer built from his $400 monthly surplus. If he lost his job in 2022 or faced a major medical expense in 2019, his options were limited to selling the home, taking out a home equity line of credit at current market rates, or drawing down other resources entirely. His $400 per month had been building wealth he could not access without a transaction. Rachel's accessible Roth contributions provided financial flexibility that home equity cannot replicate. The account was imperfect liquidity. Growth inside the account cannot be accessed penalty-free before age 59 and a half, but her contributed principal was accessible, and the account compounded at a higher expected rate regardless of whether she ever needed to touch it. So what does the real math show? 3 things. And none of them are always pay extra or always invest instead. First, the mortgage interest rate is the most important input, and it determines the answer before any other variable is considered. Below 5%, the expected return on equity investing historically outperforms the guaranteed return on mortgage payoff by a margin that compounds meaningfully over 30 years. Tom's 4.5% rate placed him in this range, and Rachel's net investing advantage at year 30 was approximately $88,000. After accounting for the additional interest she paid, above 7%, the guaranteed return on payoff becomes competitive with the expected equity return on a risk-adjusted basis. Between 5% and 7% is genuine gray territory where individual risk tolerance, behavioral consistency, and the specific time horizon determine the better answer. The mortgage interest rate is the single most important number before any other factor is evaluated. It should be checked before the debate begins. Second, liquidity is not a secondary concern. Home equity is an illiquid asset. It does not earn interest, does not compound, and requires a sale or a new loan to access. Accelerating mortgage payoff while building no accessible liquid savings concentrates wealth and risk in a single asset that cannot be partially deployed. For homeowners with strong job security, stable income, and adequate emergency reserves held elsewhere, this trade-off is manageable. For homeowners without a separate liquid cushion, directing every surplus dollar to the loan means the only financial lever available in a crisis is the home itself. Third, the certainty premium is real, and it has a measurable cost. Tom's guaranteed 4.5% return was exactly that. Guaranteed. No drawdowns, no market volatility, no year where his mortgage savings fell 30% on paper. Rachel's 10% expected return is the historical average over long periods, not a promise for any specific 16-year window. Her portfolio could have returned 6% or 14% over that span. For investors who genuinely require the certainty of the mortgage payoff return, the cost of that certainty, measured against the historical expected market return, was approximately $88,000 less in net wealth at year 30. That is the price of a guaranteed 4.5% return in a world where the market has historically offered 10%. Tom paid off his mortgage in 2031 and felt something a financial model cannot capture: the complete absence of a lender. No interest accruing overnight. No monthly obligation to an institution. No debt against the roof above his family. That floor, psychological, financial, absolute, changed how he approached every subsequent decision. Rachel reached 2040 with the same paid-off home and approximately $88,000 more in net investment wealth. They are not in different places because one of them worked harder or saved more. They contributed the same $400 per month every month for 30 years. They are in different places because one of those contributions earned a guaranteed 4.5% and the other earned an expected 10%. And that 5.5 percentage point annual spread compounded across 3 decades. The rate printed on the mortgage statement is the most important number in this calculation. It determines whether the certainty being purchased comes at a reasonable price or a steep one. You already know what that rate is. This is what we do at Vaulted Finance. The kind of money math that doesn't make the headlines but quietly decides how the next 30 years of your life actually play out. New breakdowns drop here regularly, so subscribe if you don't want to miss the next one. And drop the topic you want us to break down next in the comments. We're reading, and the most requested ones are the ones we cover first